right, so now we have worked the sell side here. The market has gapped lower with a lower gap opening. We traded above the opening of, the opening range gap high, which is previous settlement. So Friday's day session settlement price. That's what this is here. We're working inside of the old new week opening gap on August 25th, 2024. Okay, and what I want to see is, do we have the ability to work one more time taking out this low? Because it was a little shallow doing that. So if I were to kind of force myself to give you, if I had to anticipate right now what I thought was likely to occur, I think we're going to bang around between new day opening gap of August 21st and the opening range gap low until we discern what it wants to do. So I'm sitting still, I'm relaxing, I'm not worried about trying to be right about what I think it's going to do initially. My tendency is to look at what we have left over here. So these relative equal highs are just really, really, really smooth. Do they need to run up here today? No. Can it do it? Sure. I'd like to get the invitation to outline some kind of framework to get to that level, but focusing on the lecture premise this week is looking for things that are going to be problematic for your trade. In other words, what makes the idea of looking for setups harder, or once you have an opinion, okay, what makes it difficult to hold on to it, and what challenges will you find in doing that? Sticking to a bias or arriving at a bias. Okay, that's kind of like one of the primary hurdles for most of you. And my son's no different. And it was the same thing for me when I first started learning how to do this in the 90s. Knowing where it's likely to go. And also trying to push away that impulse to, I got to know right now because the market's trading, so I have to get in here because your fear of missing something. There's no reason for you to fear missing anything because the market's going to trade tomorrow, the market's going to trade on Wednesday and in perpetuity until the markets are no longer available to us. So don't worry about that. We have bigger problems if we can't trade, right? So we've worked the new week opening gap here. I liked how we done this business in here. And any movement above here, I'm going to watch and see, does it use the new day opening gap on August 21st. So in other words, trade above it, come back down, and then aggressively run into this area up in here. It's really smooth. Now, I was looking at a 2-minute chart over here because you're probably wondering, like, why are you on a 2-minute chart, ICT? Why are you not talking about that? I was looking at the gap right in here. I was studying, do they use this as inversion? Initially they did, but they hammered the consequent encroachment of the new week opening gap of the 25th. And then we have the previous settlement. So it's returned back to that, then dropped down, displaced below the relative equal lows. So sell side's been disturbed. It's all messed up now. And the market's seeking buy side, which it's already done by taking this one here. And this is a little smooth in here. They've already disrupted that. And in here, up to this high, that's where the short-term minor buy-side liquidity is. I'm watching this candle or the next to see if we can trade down into consequent encroachment. Don't look at this opening range gap high thinking that's consequent encroachment, because you can see it's different from the low to midpoint between that high. I'm annotating the opening range gap high or previous settlement. So coming down and touching that, if it's bullish, that's something we want to see. Think about what I was outlining when I was showing you opening range gaps. Let me show you what it looks like this. Think about it like the opening is here, previous settlement is here. That's the wrong color, so don't think too much about that orange, because I was looking at it as inversion fair value gap, studying it pre-market. And then the opening up to the previous settlement, which is there. Okay, so see 4:14 p.m. at the bottom of the chart, 4:14, and then the opening price here today at 9:30. So that's your regular trading hour. So now if we go over to electronic trading hours. Trading above, coming back down into the opening range gap. Because we opened, again, opened little unchanged. Little unchanged to me is less than 30 to 40 handles. So if it can't even muster a difference between previous day's settlement price and 30 to 40 handles beyond that or away from that at the opening bell at 9:30, I'm right away going to sit on my hands and wait till 10 o'clock. That is one of the things that I want Caleb to do, is discern whether or not there's a lot of excitement, a lot of anticipation. A lot of things have happened over the Middle East, and they're starting to heat up over there. So there's a little bit of trepidation right now in the marketplace. So they're going to be probably very fickle in delivery of price today because they want people's sentiment shown. Like, they want to see what traders are doing after waiting all weekend long. Now here we are, the bells rang, the gates are open, the horses are off the race. Yeah, and how is everyone going to plunk down their money? How are they going to bet? Are they looking for lower prices? Are they looking for higher prices? I think that initially they've offered some selling here to entice traders to want to do that very thing, sell short. I'm not all that terribly excited about doing that right now. I do think if things heat up in the Middle East and over in Russia and Ukraine and China and Taiwan, all those things will be catalysts to spur on more excitement in the marketplace. But right now, I'm kind of weighing out what it's wanting to do initially. So I don't want to have a hard opinion. I like an area, which is the buy side. I want to see if it could give some kind of framework to get there, but it's in no hurry to give me a market structure to work within. Back and forth choppiness in here. So the first thing, Caleb, in your rules are the rules of engagement for anticipating a really easy morning session is, are we opening significantly higher or significantly lower than previous settlement? So obviously today, it's Monday. We know that Friday is where we settled. So when we're looking at the previous day's settlement price, it's Friday's 4:14 p.m. Eastern Standard Time's price. When we pull up the regular trading hours, toggling that down here, that price is the 4:14 p.m. Friday session, regular trading hours. Now, obviously, it trades for another 46 minutes and then closes for the weekend. If it was not Friday, it would be closing for the day and then reopening an hour later at 6 p.m. Eastern Standard Time. So because we had a very small gap, very, very minor gap, that is indicative of a market that's going to be very reluctant to run. And you have to wait, let the market give you more intel. So it helps you control fear and greed, that FOMO, fear of missing something. Every little initial move shouldn't make you feel like I got to be in here. It's doing something. And it gives you a sense of relaxation and not having to be impulsive, which is very, very important as a trader. So if you notice that we have had difficulty and it wasn't easy for it to get to the new day opening gap of the 21st. So it's banging up close to it, but then fails aggressively. So now we're back on the southern end of that opening range gap. So think about that blue box there. It can work back up in. There's a small little volume imbalance right there. Watch that. Because if we can get back up in to retest the opening range gap low, that means the opening price at 9:30. If it can trade up into that, it might want to go into that little area there if it wants to go lower. But because there is a very, very weak or anemic gap from previous settlement on Friday to where we opened up at, I've already elected, the protocol is I have to wait till 10 o'clock. I want that full 30-minute opening range, not opening range gap, 30 minutes. So 9:30 to 10 o'clock, we're sitting still. There's nothing for you to do. I don't care if there's a fair value gap. I don't care if there's something exciting that appears in the chart. Because we opened very anemically, it's weak. It doesn't have a whole lot of movement. Now, we were initially, earlier on, we had a really nice potential higher gap opening, but they completely erased that. Got real close to the previous settlement by the time we opened at 9:30. Notice that. So one of the things that you're going to combat most is the want to be in some kind of trade. And especially if you're on social media and watching people like me or watching other people talk about what they are doing in the marketplace. And if you're watching live streamers that have chats, you can see that other people are chomping at the bit. They're saying, I'm long, I'm short, whatever. And I weigh a lot of sentiment with those types of tools. And I view that as a retail indicator. So watching other people's live streams, seeing their level of excitement, or if they're not all that excitement, if they're not excited about something, and I might see a directional setup. I may see something that forms or forming that is maybe bullish or bearish. And then I see a lot of comments and other live streamers saying, and it's not just that, it's other social media venues where if people that are very chatty, they like to share their opinion. The more I have that is the other side of my perspective, the better I feel about the idea. And right now, because of the technicals, we opened weak. It wasn't that big of a gap. I'm not interested in trying to form a hard opinion right away. And it'll help Caleb. And if all of you are watching, that'll also be a solid foundation to build on using the gap. Because they can't hide the gap, obviously. As soon as at 9:30 we open up, look at the difference between the previous day's settlement price at 414. You find that on the lower time frames. But I was using the 2-minute chart here, and I was watching how they were using this gap here to see if we could open up with a higher gap. If we would have opened up here, maybe at this new day opening gap or a little bit higher, I would have looked for the move to drop down into the new week opening gap on the 25th, maybe using consequent encroachment, and then try to get a long up into this buy side here. But they took it away and opened us with a really, really weak discount gap. That means it's a lower gap opening. So because of that, the amount of range. And I had one of the students ask me, what does a 20 handle move look like? So see that price here at 19,732. So all the way up to 7,052 even. That is a 20 handle price move or fluctuation. Okay. And you can see it's not much more than that for the opening range gap. So whenever I see a gap like that, I'm immediately, protocol is sit still, wait till 10 o'clock. Wait for silver bullet, wait for something that's more obvious, wait for the first 30 minutes to get in there. The algorithm is going to do what it's going to do in the first 30 minutes. And if I get into a trade, or if I try to elect a liquidity I want to target, I'll tend to be wrong. And I've seen that over 25 years of using opening range gaps and forcing that. So I just am real comfortable letting them have the first 30 minutes. And if it's a big day that I don't want to be a participant in early on, other traders might be positioned for a better short or long that may be beneficial for them holding for the rest of the day. That's okay. I'm not worried about that. I'm not forcing myself to be right. And if you look at this low over here on the 15-minute time frame, there's sell side resting just below that. So if they want to get real animated, they can take it down there. A lot of feedback, very, very positive feedback, which I appreciate. Thank you for that. So I'll drop back into a 1-minute chart, which is standard for us. So you can see right away, it's a little disorganized this morning. It's not real clean. It's a little sloppy. It has a lot of porous price action in it. That is just like the volume imbalance here. We had a volume imbalance there, which you already offered several times. No real gap in here except for the wick. And all of this spotty delivery taking us down below the initial sell side that would have been to the left of us at the opening bell. Falling short of the new day opening gap high on August 21st. So when I'm looking at price and I know that it's moving and I'm not in a trade, when I was a younger man in my 20s, I used to panic about that because I thought every run was going to be a 100-point run and be a big blast off move, because just like you, when you learn something new from me, you think that it's going to appear in every next candle because now you're keyed up on it. And I felt that way about everything that I was learning from Larry Williams and his books and his videos. And I thought for sure that, okay, he's my hero. I'm looking for this. Almost got the word that well. The pursuit of finding the new toy in the market, so that way I can play with it. I could use it to make money. And one of the biggest things you can do is learn to go slow. Really, really slow in the beginning, because you're not going to be able to retain some very valuable insights about how you think. And if you go in there and try to chase making money right away, you're not going to pick up on the clues that tell you that you're about to go on tilt. That means you're going to abandon the trading idea that you went into initially. You'll either over leverage or over trade, do more than what's necessary. And it all stems from not having a plan, not having a process of what to follow. And it needs to be very finite, very specific rules. And the first element to that needs to be, when are you going to do something? Time. Okay, so the market's going to deliver based on time, and you aren't going to execute unless you're in a time period, some little envelope in time, like a macro, the first 30 minutes. I mean, it may have to transpire. A few of you actually mentioned you thought that I was making a mistake, and you were correcting me in the comment section. And while I appreciate your enthusiasm about that, the fair value gap that I was annotating on Friday, it did not displace lower from it. So it's not a reclaimed bearish fair value gap. That's why if you saw the color of it, it was gray, because I wanted to see, does it send price down once it went below initially? It just traded down with wicks. It didn't trade up to it and then displace lower. It went higher, made a higher high, and then I was calling out why that I want to see the bottom of that be used as like a resistance, a premium array, and leave the upper half open. So no, I'm not mistaken. No, you're not correcting me, and I don't mean that to be condescending, but it was a inversion fair value gap because I was anticipating it to do what? I was looking for the market to press up into that event horizon and go into a turtle suit. And I wanted to see it fail at that new day open gap. Remember I was telling you that? I said, I'm not going to go long in here, but I'm waiting for it to press up into it. I said, if it's good, if it's really bullish, it will go up and hit that new day opening gap. But we were pressing into that balanced price range, which is going to be more formidable. And when the market broke below that gap, I outlined it real time to you all that it should act as an inversion fair value gap. So no, I wasn't mistaken, but there's logic behind it. This is why I said anybody that talks about inversion fair value gaps or fair value gaps at all, every gap with 3 candles does not make it a fair value gap in the context that you think it is. You don't have all the other tools and resources and experience of reading what the narrative and price action is. Go back and watch Friday's live stream again. I'm watching the volume imbalance here. We already had one tap into it there. There's a second one. Now, when you go through each one of these live streams with me, whether you're watching it rather live or if you're watching it later on, I want you to really spend a lot of time writing in your journal when you're taking screenshots. Compare the differences of the first 30 minutes of trading with every other day. And when I really make a big glowing remark and start gushing about how pretty and clean price is versus days where it's spotty, a little disorganized. Those are real key things to annotate in your journal, because those are the things that's going to be much more paramount for you as a day trader. We just swept that low here on the 50-minute time frame, and we traded inside of an old buy sign of balance, sell sign of efficiency, which is right here. For instance, like immediate rebalances, okay, where you have a run in price. Perfect example. We have the market stop with a low right here. Then we have a big candle that went lower than the previous candle's low. Okay, it doesn't matter where we're going next. Okay, what I'm saying is things that key up on your attention, that you're saying, okay, there's something going on here. I'm monitoring this. The very next candle is a large candle down. And then we have this candle open and it trades all the way back up and touches the previous candle's low. So all of this down candle, the black candle here, that range is completely redelivered with buy side. So if we're looking at it like this, make it a little bit wider. The separation between this candle's low here and then the big long black candle that goes down, if this would have opened here and traded lower, this would have been a fair value gap. But it opens and trades all the way back up and touches that. That is called immediate rebalance. If it does that when you're bearish, that's one of the best indications that you are entering at a, like if you want to trade imbalances where it completely closes down. I just found a guy on the internet on YouTube trying to teach imbalances and fair value gaps and saying that fair value gaps are a renaming of an imbalance. No, it's actually a very specific signature where it is not filling in. I don't want to see it fill in. That is the superior form of trading price action. If you're going to look for these inefficiencies, the highest order of trading them is you want to see them not close in. And I've proven this in live sessions with real trades, with real money. So if we're looking at the price delivering back up to that level there, that mechanism right there, it matters not if it goes higher or lower. What I'm saying is this right now, and when it does that, as soon as it touches that candle's low on this candle, it delivered down and the next candle opens and it rolls right back over top of all of the down move from this candle's low right there to where we opened. All of this has been redelivered back to that price. So this is efficient. If it's bearish, that's really strong. Or if you're in a trade and it starts creating these types of things and it goes right back up, then you can say, all right, I expect it to trade aggressively lower. It's done what it needs to do to rebalance, reprice, and it need to do it real quick and sudden. It's kind of like showing a hand of a winning card hand in poker. If you're a partner that you're at the table with and they flash their hand to you and they're sitting with a full house, 4 aces and a king spade, like it's going to be hard to beat that, right? So that's what the algorithm is doing. It's kind of like tipping its hand saying, you know, I'm getting ready to do something really stunning, one directional, and an immediate rebalance is one of the purest forms of reading it in price action. So when you see that, it kind of like promotes large range, it promotes speed, it gives you a lot of indication the market wants to behave a certain way and a certain characteristic. And you can see it happening here, by the way. So it did it there, and boom, we took out the low. That in itself might be your model. Alrighty, let's go. And we have the complete closure of this buy side imbalance, sell side inefficiency. So I want to annotate that so you can see where we're at in relationship to the 1 minute chart. So look over here in the 15-minute time frame. It's this big up close candle. The previous candle's hot and it didn't quite get down to that. That's enough. So your model might be, let's say you're bearish and you feel comfortable being short. You want to look for sell side. Wonderful. One of the strongest indications of you're about to see a price run that's one direction, and it's going to be nice, quick, sudden, big candles. As we were outlining here, big down close candle, immediate rebalance right there. Now, what happens if this candle that opens right here after this big down close candle, when that forms, what happens if the next one doesn't go right back to that candle's low right there? It's valid if it does it on the next candle, but after that, it's not. So immediate rebalance is this single candle that creates a big range lower and a lower close. The candle must be larger. Larger than what? Well, look at all the ranges. Once this has formed, this stands out against all the other previous ranges, right? It works on all time frames. So if you're a very short-term scalper, or if you're in a trade and you're waiting for price to give you that last little bit of movement, and you get a candle like this, if you were short and you want to get short or add a pyramid, as soon as you anticipate this candle closing, as soon as it closes, watch where we open on the next one. Anticipate, feel comfortable with it running right back up to that candle's low. If you're short already from some higher place, this is not a reversal, but the only thing it's doing is exactly what you want to see it do when you're bearish. You want to see it run right back up, rebalance that. And if it didn't do it on this candle, the next candle, if it went and touched it, then I would expect speed delivery to the downside. All right, so we're in 5 minutes into the 10 o'clock hour, so we've had 35 minutes or so of opening range. We could not get all the way down to this run here on the 15-minute buy side and bounce sell side efficiency. So we took out relative equal lows, this low. I gotta make sure I slow down. That way you can see what I'm pointing to. I make this mistake all the time. This low and this low, upper left-hand corner chart. So those two are relative equal lows. We have traded down through that, but we didn't close in the entirety of that buy side and balance sell side efficiency, which is this candle right there, this big 15-minute candle. So that is seen with this little area down here. So let's say we're anticipating a turn in the marketplace. How can you study that? Well, we have an indication that it couldn't get all the way down to the buy side and balance sell side inefficiencies low on the 15-minute time frame. We are seeing an initial run back to, but look where the bodies are. So it hasn't proven anything yet. Even though we had a little wick here, the bodies are saying, no, it's not there yet. So sit still, relax. Now watch the wick here. That's consequent encroachment. Right there at that 19,701. So far, we're only working with the rejection block, which is the lowest down close candle price, closing price. It swept that here, but we're still inside that 15-minute discount buy side and balance sell side efficiency. Having a model, having a context, if you will, of what you're watching price for. If it's not in the price action, if the thing that you're trying to capitalize on, trade on, frame a setup around, if it's not obvious in price action, why are you worrying? It's just indicating you're impatient. You're fearing a missed move that someone else is going to probably come back later on and say, this is what I did. And maybe they did do it. Most of the time, they probably didn't. All right, so we finally snapped through the 15-minute time frame, buy side and balance sell side efficiency. So now this inefficiency that we just traded through offer the opportunity for this to act as an inversion fair value gap. So now we can watch the lower end of this here. So that would look like this. We can take that level right here. So this level here is half of this shaded area. If it wants to return back in, it's bearish as long as it does not go back above that midpoint. It can wick to it and through it, but it's better if it just trades back up into here and falls from that, not return to the upper half of it. You can see where we have a lot of the new day opening gap and new week opening gap. That's a big, big draw because it's layered. They're all nested together. We have that new day opening gap from the 23rd, and we have the 18th of August new week opening gap. So a real nice setup would be something like watching it trade up into that 15-minute fair value gap that we traded finally through. And notice when I was telling you we were back here, I said, nothing's happened yet. You can't try to pick the bottom yet. Anybody that tried to capture the long here, they got stinky fingers now. You pick your bottom, you're going to get shit on your hands, basically. So you have the bodies telling you, no, we have not turned around yet. What is it respecting? The fair value gap on that 15-minute time frame that I've been drawing your attention to. So while we did have that immediate rebalance here and it rolled down, it came right back up to the high end of that 15-minute fair value gap, but did not close out of it. The bodies are saying, watch me, hello, neon sign, nothing's happened yet. Everything is still in motion going lower. So if that's the case, what are you looking for? What's below this 15-minute fair value gap? Well, we can have the new week opening gap and new day opening gap. These levels in here, like I said last Friday, they're like a big black hole when they're nested together like that. Like it's such a huge influence on drawing price to them. So like I said, it would have been nice for it to offer a return back into that 15-minute fair value gap or get into this city here between this candle's high and that candle's low. So far it's respecting the lower level of this wick here. Focused on slowing down. Demand that price is giving you something that's obvious. But those are the things that you have to watch that are problematic. So if you're looking for setups, if you ignore what price is doing and you're not taking in the intel that it's providing to you, information that's going to be helpful to you, or canceling. If it nullifies any interest in the marketplace, you have to be thankful that you can take that out of price action. What is your priority right now? Is number one, to move slow. Let anything that becomes important to you manifest itself. It's got to show itself in the chart and say, okay, I see this and this is causing me a concern or question, and I'm curious, or I have a doubt about something being there that maybe I should be looking at. That's all normal. And you write those questions down in your journal. And then when we sit down with each other on Saturdays, you'll be able to tell me, this is what it is. This is what's on my mind right now. And I'll tell you, well, this is what you do with this question or concern, or I'll answer it for you. Or I'll tell you, that's not even something that you should be worrying about, because there's going to be a lot of that stuff in the beginning. Worrying about the things that are not important in the beginning is a huge time waster. And while I do have a lot of content and my videos tend to be long, it's meant to save you years of doing stuff that's not fruitful versus listening to a lecture. I mean, if you were in college, say I was a college professor and I wasn't teaching trading, I was teaching, economics, or I was teaching psychology, you'd have to hear me drone on and on and on. So why are you trying to shortcut it all? You're here to learn it. You're here to try to get a PhD in price action. So every time you sit down with me, that's what we're doing. We're focusing on the things that are going to be very important things that you don't think are important right now. But when you start watching your trades in the future, like for instance, you may have, when we're looking like this, I guarantee you somebody out there was seeing this low, and this low, and they're thinking, okay, that's a 3 drives pattern. And then they saw this big run like this. I say big, but it's not really. But it was sudden run right up in here. And then when this candle was bullish, it looked like it was a reversal to them. And they probably already had a trade being recorded, so they can go on social media and say, I did this against ICT. And they're doing all the wrong things too. They're trying to look right instead of staying here and learning how to read price action correctly. But I told you, the bodies were telling you nothing has changed. Nothing has changed. And the only thing we've done is we've left this small little portion open down here on the 15-minute time frame. And we want to see that shaded area become an inversion fair value gap. So that means you use the high in the midpoint. It trades up to it, it rejects, and goes to the lower half. At that time, you don't ever want to see it go back above the midpoint. Ideally, you want to see it trade, once it leaves it here, go up and bump that, wick into it, and wick just below the midpoint or consequent encroachment, and then leave. In the very next fair value gap, because we're on a 1 minute chart right now, if it were to do something like that on a 15-second, 30-second chart, 45-second chart, the first fair value gap, once it leaves the inversion fair value gap and it displaces outside of it, the very next 15, 30-second, or 45-second fair value gap, once it trades into that institutional order flow entry drill, use that and then target the next sell side liquidity or inefficiency. And I told you last week that this is like a huge black hole. And we were up here, and I said it's going to draw into that. It's a very, very large magnet. Okay, it's gonna suck price in, and it's going to gravitate to it. The breakdown out of this inversion fair value gap on the 15-minute time frame, there is no gap in here. 10 o'clock is here, right there. Okay, so he has to find a fair value gap. No fair value gaps. Small one there. Nice one, it could have been there. I even talked about it live with you. I said it'd be nice to see it go up in there, because that would be a real nice model for it to shoot from here down to the new week opening gap, new day opening gap that's nested here before it traded down there. Look at the bodies right on that high of the new day opening gap from August 23rd. What does my model say? Should I be doing anything here? Should I be trading at all today? That's the right perspective. What I want you to do in this, Caleb, is go through all the delivery on the 1 minute chart, the 5 and the 15-minute time frame. Match up everything, that any kind of retracement, every up close candle on a 1 and 5 minute chart. You want to find the reference point on the 15 in relationship to where it's reaching, where it's traded to here. I want you to note every inefficiency, all the ones that stayed open, and I want you to note where we close at noon. And everything prior to that is the AM session run. I want you to study all that. It should have been fun watching it. Gravitate down to this new day opening gap nested with a new week opening gap. We had a level here and we outlined on the 15-minute time frame. Old low. It traded to that and accelerated down through. Next candle opens, wicks up, overlaps the new day opening gap, and then the acceleration to the downside. You want to take a screenshot like that, annotate your observations, and sell side here in a time frame. You want to annotate your observations on that chart like that into the afternoon and to overnight going into tomorrow. You want to have that sell side and then this buy side and balance, sell side and efficiency. What is going to be important for me, this delivery here on that one single candle overlaps this single candle right there. Normally, this would be viewed as a balanced price range because it's offered sell side. And then over here, it starts at the same level here, buy side's been offered. So this range is sent lower and back up. So it's offered both sides. If it starts to go into this and it's doing it with speed, then we have changed in a degree that's going to start sending us lower for weeks, not just a day or two. So that's what I'm using this information here. I want to see if we can get into this area, is it doing it fast? Because it should not do it fast. So you look at this and say, oh yeah, this is one of those areas where it's open traffic. Okay, it's going to be easy for price to get down into that. Not if you're looking at it at the same time that it's delivered like that. If it does it quick, if it trades down in here and it does it quick, that's indicating that we have turned the corner up here, and then we're probably going to want to trade lower. On a higher time frame, there's a lot of interest, especially with all the stuff that's going on around the world. There's a lot of WARU paying attention going on, and right below here, I see that getting attacked before we get to the holidays, and that's a big move. But it has to do what I just outlined moments ago. So we traded below there. Next sell side of any importance is here because this has already upset those relative equal lows as well. So that is key sell side liquidity. This inefficiency we have to watch going forward if we can get into that. And let's just put it on the chart so it's there. You're keeping yourself from picking up toxic thinking. You're looking at it properly. You're observing price. We had objectives. We were watching price and it delivered. That's how you should feel about it. You should feel that we were able to see where it could gyrate to, where it could reach to. That was here. From here. As soon as we saw that the bodies were not indicating that we were going to leave the fair value gap on the 15-minute time frame, bullishly leaving it going higher, your eye is still looking for sell side liquidity. Your eye is looking for discount arrays. You're looking for discount inefficiencies. That's all this stuff here. Where can it likely draw to? How do you know that? How do you know when the market's not likely to continue running, as I indicated in here? 1, 2, 3 drives. There's logic in reading price action like this in a relaxed state. You're taking information, you're collecting it, and you're observing. You're going to look back at this price run here 3, 4, 5, 6 months from now. If you've done it, if you took the time to go through and look at the observations you make today and make that in your journal. And then when you look at it half a year from now, 6 months from now, next summer, when you're looking at price action, you're going to see so many things that you don't see right now. And it's going to be so obvious to you that it's there, but you can't recognize it right now. Think about what we showed so far. We have the optimal trade entry, and then you had my daughter's model 2022. Then you had Silver Bullet, and now you're seeing that new day opening gap, new week opening gap with a fair value gap, the first presentation. Silver Bullet's always there. Every single day, Silver Bullet's there. What's impressive to me is you didn't feel comfortable taking the trade, even though you saw it. You didn't feel comfortable with it. Something about it didn't feel right, and you didn't press into it. You've monitored price, and it delivered. The takeaway is you controlled yourself. You didn't break the model. You didn't chase price after it started moving after your model spoke. That's what I'm impressed by. I'm impressed by that you saw that it was there. I'm impressed by that. That's normal progress. That's the thing that you should be focusing on. There's going to be times when your model is going to say, yep, it's a time to trade. It's there. And you're going to say, you know what? The daily chart, what it's been doing, what we got in that calendar later today or later in the week, I'm not touching this one. I'm just going to watch it. And if it moves, great. I'm entertained by that. It just gives me one more little nudge of assurity that I know what I'm doing and what I'm looking for. But if you make every fluctuation and every single time you sit in front of charts about making money before you know how to make money, you're going to lose money. And that will repeat all the time. And the only thing you're going to get from that is regret, toxic what-if thinking, and you're going to be fearful to take setups in the future. You're going to be fearful that it won't work because you are forcing inexperience to deliver Olympic feat results, and that doesn't ever work. It never works. So when Dad tells you to relax, don't look for these things to be, I have to show that I can call it when it got to the right fair value gap and it went to where I thought it was going to go. That will come. I know that will come. But that will come as a result of you doing this. Relax. Watch price. It reaches to the levels we understand. We are looking for it to gravitate. How did you feel as price was dropping down there? We went down and stopped with the bodies here. We went outside of the new week opening gap, right into a up close candle. It needs to be on the highest succession down close candle. So that's wrong. And even in your diagram, you can see prices go right to the opening price of the second highest down close candle. That's the change in the state of delivery. Okay, that's the order block. Watch the buy side here. Note that one, okay? Just for the PM session. So even if it wants to go lower, I'd like to see it trade up there, bump that, because that would be where anybody short would have trailed their stop loss.